In 2026, tax audits in the United States are changing. The IRS is introducing artificial intelligence, data analytics, and automated control systems. Audits no longer work the way they used to. It's no longer random selection. The system doesn't look for obvious violations first, it looks for patterns. Your tax return is compared to thousands of similar cases. If your numbers significantly deviate from the norm, your audit risk increases. Here are the key situations that most often trigger an audit. First, mismatch between income and expenses. If your reported income doesn't align with your lifestyle and spending, the system flags it. Housing, vehicles, and overall cost of living are all considered. If expenses exceed what your income supports, it raises a red flag. Second, vehicle usage. Claiming 100% business use of a single personal vehicle is often seen as unrealistic. In such cases, detailed mileage tracking is expected. Without proper records, deductions may be denied. Third, home office deductions. The size and use of your space must reflect reality. The system cross-checks property data from public records. Overstated or duplicated space is a common trigger. Fourth, expenses that don't match your industry. Each type of business has typical expense patterns. If your spending looks unusual compared to others in your field, it may draw attention. Fifth, excessive meal and entertainment deductions. If these expenses represent a large percentage of your income, it may be flagged. Even allowed deductions must appear reasonable in context. Sixth, short-term rental activity. To qualify for certain tax benefits, active involvement is required. If your time and workload don't match your claims, the system may detect inconsistencies. Seventh, trips labeled as business travel. If the primary purpose of the trip isn't clearly business-related, deductions may be denied. What has changed the most is the overall approach. It's no longer just about following rules, it's about consistency. The system evaluates whether your entire return makes sense compared to others. To reduce audit risk, one thing matters most. Your numbers should be consistent, logical, and reflect a real life.